Hi everyone, our guest today is Steve Reisner. Steve is a full-time trader and a moderator and trading coach with Hit and Run Candlesticks. Steve is a retired Air Force fighter pilot with master's degrees in both business and computers. He began investing in the early 1980s and then actively trading in the 1990s. He's been trading full-time since 2009. Steve moderates the live futures trading room for Hit and Run. There, traders can see his charts and listen to his commentary as he trades the NASDAQ, Dow, Oil, and Russell E-mini futures. He augments trading with presentations on the setups he is looking for and helps traders configure their systems to trade futures more efficiently. Steve resides in the Orlando area, Florida. His topic is $2,000 a month with a small account and low risk. Steve, thanks for joining us. Welcome.
All right, thanks, Ron. Thanks for having me to the Denver Trading Group, and thanks everyone for stopping by. I'll try to live up to that introduction. Let's get started into the next slide. I got to start with a disclaimer, is that trading involves risk of loss of capital. We all know that, but we have to say it. I'm going to start with a little bit about my background, but Ron's already covered most of it, but I think I might touch on a couple of things there. I'm going to start with, the benefits, the potential pitfalls, and which are the, quote, best E-minis. We're going to go over some chart settings and some high probability patterns. It's after that I'll basically open up to, some example trades, and we'll get more into the Q&A. If you have some questions, even if you put them out there, I'm probably not going to answer them until we get through the formal part of the presentation, which is the high probability patterns. And then I'll probably go back and take a note for yourself about which slide number it was or what the slide title was. And then we'll go through the example trades, tell you why you might be interested in the live futures trading room that we've got there. I'll roughly hit the performance that's as of today, and then we'll possibly I'll pop up a couple of ad hoc slides of some trades that went on today. All right, a little bit of background. I was the Air Force equivalent of the Top Gun instructor. I was lucky enough to be able to do that. I did have a Series 7 license. I'm no longer associated with them, so it's lapsed. And I'm a technical trader, but I do look at fundamentals when we're talking about stocks and options and things like that. But we're here to talk about futures today. So we're having an open house through the 31st of August. You got the room listed there. I will be able to hand that out to people at the end of the presentation. I'll make sure you get that out there. But what are the E-minis? Well, most of you probably know, but some may not. They're basically electronically traded futures that are at a small fraction of the cost of a full-size contract. Most of us can't afford or probably wouldn't want a full-size contract. This makes it very affordable for the average retail trader to control, as of the 3rd of August, $140,000 worth of the cost in the S&P E-minis. That's quite a bit. Now, I trade with Ninja Trader Broker, and my intraday margin is only $500. So each broker has their own minimum for the margin requirements intraday. Everyone has a standard number that they have to cover if they're going to carry overnight. I do not carry anything overnight. I am your typical day trader, so therefore I'm not carrying things beyond. To me, I don't carry it beyond 3:45, 4 o'clock, and I'm out. If you want to find a little bit more about the E-minis, you can go to Investopedia. I'll make sure you get that link when we get to the end of the presentation. A little bit more, there's the link to Investopedia. There's some additional links on the E-minis and Wikipedia. And NASDAQ has a pretty darn good description of that, and I'm going to cover some of the stuff from that bit. Now, trading strategies, in 2009, this is a snapshot that the volume increased by 37% while The equity volume only increased 2%. So that means a lot of people are moving over to the futures. That's about the same time I started getting interested in the futures, to be honest with you. And Goldman Sachs, again, back in 2009, spent more on their black boxes and their algorithms than they did on all the staff for the trading desk. And those people are fairly well paid, you know. So, you know, that probably says something. Okay, next slide. What are the benefits? Well, pretty darn liquid. In the third quarter of 2017, the S&P E-minis traded approximately 1.4 million contracts per day. That means that they're extremely liquid. You can hit the market order, and the most slippage that I've ever had, even in the fast market, is two ticks. They're very technical. They don't have obviously the fundamentals that you have to deal with, but obviously economic reports and how the individual stocks and securities do drive the prices. I like the round-the-clock trading. It starts at Sunday at 6 p.m. and goes basically straight through until Friday at 5, and these are Eastern time. They do take a 45-minute to 1 hour break. It's from 4:15 to 6 p.m. where they tally up the books and clean up the desks for the next day's trading. And it allows people, if they want, and they're able, to maybe trade the Asian Open at about 8:30, 9:30 o'clock at night, Eastern time, for people who want to trade the European session from when Germany opens at 2 until about 4 or 5 o'clock in the morning, and get started as early as maybe 8 or 8:30 in the morning Eastern time and trade through about 11 o'clock. I tried doing all of those at one point in time, and it turned out it was basically killing me. So I had to decide which time frames I wanted to trade. It doesn't require a large account. A large account in my book, large enough, is probably $8,000 to $10,000. So you don't have a pattern trade day trader rule. So you don't run into those because you're considered a professional from the minute you start trading the futures. There are no wash sale rules. Yay. Obviously, it's easy to go long or short. And tax advantages, the stuff in the NASDAQ points out that 60% of all your winnings, your profits, are considered long-term and taxed as long-term gains. 40% of your profits are taxed as short-term. And of course, all of mine are short-term. And the new tax law allows a 20% exclusion. And again, I'm not a tax person, so I expect everyone to look and go to their tax advisors. But I have a subchapter S corporation, and I get a flow through down to all the profits go in directly to be taxed at my personal rate, but I get to exclude 20% of those profits this year. So there are a lot of advantages tax-wise. And here's one that is absolutely amazing that I love. Minimal record keeping. Even though over the years now the brokers have to give you a 1099 that breaks everything down, you have one number to report from the broker, end of year, done. Minimal daily prep time. You don't have to go try to find things that are in good patterns or bad patterns or whatever. You've got, in my case, 4 indices to watch, and I look them on a daily basis. Then I drill down to a 15-minute chart, pre-market. I go over all of those with our members in the room, and then we are off and running. And last but not least, you can get some really fast moves. That can both be a positive and a negative. All right, potential pitfalls. We all have to worry. The ease of execution is out there, but we all need to worry about overtrading, revenge trading, trading too much. There was some gentleman that just recently revealed to me that they made $100,000 last year trading the futures. And I went, great. He said, not so fast, sunshine. I said, why? He said, because I lost $150,000 this year. Oh, how did that happen? I don't use stop losses, and I don't have a strategy. First piece of advice, stop trading live money. Let's go work on your trading rules. Let's go work on your thing. And he signed up, and one of the first guys signed up for my room. All right. Losses can be huge if risk is not managed, like what just happened. Moves can be fast and vicious. Usually to the downside is a lot faster and a lot more vicious. Now, we've got to worry about the high-frequency trading black boxes and the institutions. Trading the ES is like swimming with the sharks, the piranha, the barracuda, and the killer whales all at the same time in a very tiny, tiny pool. They're not after us. They could care less about us. We're nothing. But the problem is they're all trying to bite somebody else, and they're going to eat us while they're going after somebody else. Now, I kind of love this one. I've got kind of an engineering background, even though I've got, the computer background, and I started off in engineering when I was in college. And I said, I'm pretty good at math. I said, oh, yeah, I'm good at understanding numbers. In a second, and he says, stock market's made of numbers, therefore I went, what? Where did all my money just go? Yeah, just because you're good at math, just because you're good at something else doesn't make you a darn good trader or futures trader. So be careful. Got to get some education. Now, I've been asked numerous times, which are the best to trade? Well, let's first of all go over a little background. The S&P is $12.50 per tick and moves in quarter point increments. So for every point is $50. The Dow, $5 a tick, 1 point increments, $5 a point. $5 times 1.0. The NASDAQ, $5 a tick, quarter point increments is $20 a point. Russell, 5.1, 50. Crude oil, the monster out there, $10 a tick and 10-cent increments, $100 a point. Now, you can pick your poison because each one of those have different volatilities. Each one of them has different characteristics. So which is best? It's probably going to depend more on the amount of money that you want to have at risk. I don't use one size fits all. Every trade is conditional on a reward to risk ratio for me. So I look at where I'm entering and where my potential targets are, and I do a quick estimation, a guesstimation of what that would make in a if I hit target 1, target 2, or target 3. Now, we'll talk about those in a little bit. So what we're really talking about is, does this have the potential to make money, or is the risk too great for the reward? The Dow and the Russell are normally less volatile in total dollars. The NASDAQ and the S&P are basically the next, because the NASDAQ moves, but it has lower dollars per point. The ES doesn't move as volatile in a volatile manner as the NASDAQ, but it has more dollars per point. And finally, we're looking at the crude oil, which has high dollar value and fast moves. Okay, crude oil, I do like to trade on the inventory day. People have been in my room say, this is crazy, you don't trade crude oil other days? No, because a lot of times it doesn't set up properly. We don't have good setups that fit the needs, but I can definitely find usually one good trade and get anywhere between $150 and $200 off of crude in one quick trade on inventory day. All right, here we go. Let's see. Chart settings. Number 1, keep it as clean as possible. Now you're gonna see I've marked mine up a little bit more than you would probably do otherwise, because I would see the swing levels without having to mark them up. But some of these charts you're going to see that I've already marked them up because I want those in my room to have to gravitate to those lines. They can be blue lines or shaded yellow lines. so that they can know where potential targets would and entries would be. Now you need to choose your time frame, and by time frame, I'm going to lump in together time-based, trade-based, and price-based, all as a time frame. When in fact, really only one is time-based, like a 1, 3, 5, 15-minute chart, whatever you use. A trade-based would be something like a tick, and a price-based would be a range of Renko. I'm going to go into more on that in the follow-on slides. But we've got to really remember, need to minimize the number of indicators using to ensure that they add value, and that whichever ones you have is a personal choice, but don't have duplicates. If you're using a momentum, let's see, a CCI, and then use something that's very similar to it on the same time frame, don't do that. They're superfluous. Now, I will allow myself, and I think it could be valid, to use different momentum indicators that are on different time frames. One faster or slower than the other. In fact, I do that on mine. How come that moved off? Okay. Data-based candlesticks, or bars, or bricks. Tick candles are based on the number of trades. They can help traders judge the market activity because they basically know the number of trades that are out there. Unfortunately, the downside is every trade is equal. If you have one contract, 10 contracts, 100 contracts, they're all one tick. So they don't really tell you. So a lot of people look at volume candles. They're based on number of shares in contracts, and that will help somebody look at the market activity from a volume perspective. I don't use that. I use the Renko, which is a special type of range bar that is based on price movement, because I'm a price-based person. I was that in my days when I spent a lot of time trading on stocks. I pulled it over with me, and it works really well when combined with swing levels. So it helps you look at the volatility. You can see how much it moves, and to visualize the trend, because it reduces the noise by only focusing on price. If there's lots of little movement that doesn't go anywhere, it doesn't show up. It gets lost in the candle, and since it's based on price, you will also see when the market's slowing down, because those candles stop printing. They just stop dead. There have been times, and a couple times today, yesterday, that after the FOMC minutes were out there, I said, is my computer dead? Because we weren't printing new candles, because it wasn't moving. All right. For some reason, it keeps coming off. All right, here's my chart settings. I use Unirenko bars or bricks. I use 2 moving averages, and they help me visualize the trend. And the 2 that I use, and I've tested this over some period of time. I've been about 2 years of trading this, and I've come up with that the 9 volume weighted moving average is my fast moving average, and the 20 simple right here is my slow moving average. All right, and I use an R squeeze, which is nothing more really than a Bollinger Band squeeze, or if people are familiar with John Carter's stuff, the TTM squeeze, basically the same. And I use swing levels and trader pivots. And the swing levels you'll see like here that are automatically drawn. They're the daily trader pivots. And you'll see swing levels identified by the computer based upon the highs and the lows. And the yellow ones here are the lows, and it helps me determine basically support and resistance levels. All right, high probability patterns. We're always in the quandary. Do I take a trade or not? Is it good here or bad here? I use these as my kind of go-to bits of information to keep me on the right side of trades. I want the market to prove that it wants to go in the direction I think it should be going, or it will want to go, by making it break through these levels. that are swing levels that are support and resistance. And usually when it breaks one level, it'll go up or down to the next level. So the three favorite patterns I've got are the same ones that I've used in stock trading for a number of years. And they're a zigzag or J-hook, pop out of the box, both above and below, and a continuation move. And each one of these has a bullish and a bearish case. And all the targets, like I said, are really the prior swing levels, either up or down. And the key to making money and to staying in the game is managing your risks so you don't get blown out and blow out your account and you can still be trading. Better to lick your wounds and to retreat and live to fight another day than to get blown out continuing to try to trade and losing lots of money. All right, let me see if we got zigzag pattern. Basically, it's not the zigzag that you might see with an indicator. This is a little bit different. We're really talking about an up move, followed by a down move, followed by another up move. As my colleague Stephen Bigelow would say, this is a J-hook. You have an up move, followed by a retracement, followed by a curl back up and an up move. He introduced me to that, 8 or so years ago, and it's become my go-to pattern. Well, in futures, it does roughly the same thing. And you have, you watch what happens at some sort of resistance level or when it gets up, and then it comes back, and you see where the support level is, and you see that marked by the red box. And when it starts up, you have two choices then. You can wait for it to break above, and this is the traditional J-hook, is wait for the breakout. Well, sometimes waiting for the breakout is not the best thing. Sometimes you should be going long just above the bottom so you can have a tight stop. And you use that break or non-break of the swing high there as either your first target or your checkpoint to make sure that it's going to continue to go through there. And all the while, I'm watching what the momentum indicator is showing me down at the bottom. If it's working properly, it should be rising like it is here. And it went kind of sideways here, even though price went up still. Then it started to come back as price retraced. And then it started to curl back up as price started to go back up. Trading is an art, and it's not math. So you can't just say 1 and 1 is 2 always. All right. Now, I'm going to cover measured moves in an example, a rare example today in the NASDAQ, where we had multiple measured moves back to back to back. But basically, and a lot of times you'll get the order of magnitude of the first move. And in this case, I believe you really had one move from here, followed by that, and then another move here, and another move here. That move equals that move equals that move. Even though I showed it drawn in a blue line all the way up to the top level here, this was actually a zigzag 3 move. All right, let's go on to the next chart. Pop out of the box. It's really a consolidation area, but it was given the name of the pop or out of the box, or put beef by one of our moderators called by the name of Doug Campbell. It makes it easy, but basically you establish a trading range and you break out. Well, this one, the case is you started down into that trading range and you broke out in the opposite direction for its a reversal. Sometimes when it breaks out, it'll retrace. But many times it does not. Because what's happened here, when the reason it established that trading range in the first place, was that it was trying to decide which way to go. And if you look down here at the bottom, What's happening with the momentum? As you go from left to right, the momentum is getting stronger and stronger. It's giving us a hint that it wants to go to the upside. So I use this indicator to say, I'm looking for a breakout above the top of the box. I pop out of the box and then looking for it to go boom, take target 1, trail to maybe another target. Maybe there was a swing level up here and take it off the table. The targets are always the next swing or resistance level. All right, the opposite of that is a drop out of the box, or like I like to call it, the poop out of the box. That's where you get into a consolidation period, like shown here in red, and then it exits in the same direction downwards. Again, sometimes it is does retrace and do a bit of a bounce, but in, I'll call it weak markets, not strong, it'll blow right through those numbers. It'll just keep right on going, especially to the downside. And what do we see here when we're looking at the momentum indicator? Momentum indicator here matching the box is pretty much stabilized, but then it starts to weaken, giving me an indication that we're probably going lower. It's all about playing the odds. Let's talk about the bullish continuation. Continuation patterns with the settings that I use is usually about a 3 candle pattern. What it does is basically has the first candle is green, the last candle is green with a red one in the middle, and they're about of equal tops and bottoms. And what happens on a normal case is as it enters here, goes sideways, and it exits to the upside in the same direction that it entered. And here's where you're looking for the measured move. The distance is about equal a lot of the time. All right. If for some reason you saw this too late and you didn't get in, what you can do is use that for an entry. And you can go long in the breakout, using the stop below 2 ticks below the lowest of these 3 candles. Alternatively, if you use a volatility stop, you could use one of those. What I do is I have the volatility stop up, I'm aware of it, and I try to do what I feel is correct based upon technical patterns. And not just feeling, but it's a which do I believe to be correct? The bottom of the boxes, is that what I can take? Or can I let it go all the way back to the average true, the average true range is what the volatility is based on, but can I let it go to the volatility stop? Well, one of the ways that I use that is, do I need, let's change the color of this box here. Let me change that to red. If it goes up, up, and goes up on the second, and these last 3 candles don't exist, and it does this, and this, and this. Do I need to let it go all the way down here to realize that I'm wrong? Well, no, because the volatility, once it gets up a couple of candles, see what happens to these volatility stops? They start going up as well. So you're probably, once you get a couple of candles in your direction, a couple of bricks, that volatility will start to rise. And what happens here is the volatility is rising, and when you go into the consolidation, it goes sideways. Then it starts to resume the upward path. And I watch to look at are the momentum indicators, and I call this my momentum indicator, and this is the R squeeze, but they are both momentum. Look at the momentum indicators to see if they're still pointing up. And then I have to do a judgment call of what those numbers are. Are they extended for this time of day, for this instrument, for this range pattern? All right, and again, In many cases, the magnitude of the second move will equal the first as a measured move. Bearish is the opposite. 3-candle pattern, it broke down. If you didn't enter it, where can you put your stop? You can enter lower with your stop right above, 2 ticks above the highest candle in this pattern, unless you have a volatility stop that lets you do something different. But they're usually going to be about the same. You have to judge whether momentum is sufficient enough to let you go. Right in here, the momentum is passing through the 0 line. That's good enough for me. Down here, the R squeeze is not in the squeeze, but it's a little bit below the 0 line. Is it extended too far? I don't know. Look how far it went down here. Do we expect it to continue the same order of magnitude? Look back over to the left. Are there any support areas or levels? And here's the primary pivot. I'm going to tell you. Primary pivots do not stop. Pivot levels and trader pivot levels don't stop the markets from going in the direction they want to go permanently. They may act as a temporary wobble, but I say that if you look at any of the pivot levels that are acting as support or resistance, if you look back to the left, the vast majority of the time, and I'm going to pull it out my backside, of 85 to 90% of the time, there is a swing level over to the left that matches that. And I'll stand by that one any day. All right. Last of the formalized things, we're going to get into real trading here. Trading rules. I learned this a couple of 3 years ago when I really started seriously trading full-time on the futures and only the futures. All right, what we're looking for is to quit trading if you meet or exceed. This is called power of quitting. You may have heard that in a presentation or two. You meet or exceed your daily goal. Well, I mean, that's in a positive direction. That's green. Well, what happens if you exceed your daily loss limit in dollar amounts? What if you exceed your daily loss number of trades? Now, mine is about $450 here, and then 3 trades in a row. If I've got 3 trades in a row that are losers, they're going to indicate that I'm totally out of sync with the market and I need to stop trading. Take a break, take a breather, walk away from the computer, give it up, and come back tomorrow. Now, during the nighttime, I'm going to go do my homework. I'm going to figure out, go back and look at it with a fresh set of eyes and say, was that me? That I had a bad entry? Did I misread what was going on? Or did the market just not do what we expected it to do? And that happens. Well, I can tell you I've been in both sides of that, where I had a good entry, and tell you what, if it happened again, I'd enter it every time. And it just didn't work. There have been times that I've looked back at it and said, Steve, this was right in front of you. One, why the heck did you get in there? This is crazy. And there are other ones you say, Steve, this was right in front of you. How come you didn't get in? You need to analyze, though, and do a post action, after action review. So you need to look and see what you did and what you didn't do every time. And I have a whole presentation on that. Anyway, following the rules will help me maximize my gain, minimize my losses, and keep me in the game. The whole idea is not to blow out your account. Okay. Again, if you fail to plan, this is the gentleman that I was talking about with the no strategy, you're planning to fail. All right, let's go to the next chart. All right, I'm going to open up for any questions here. I see some short questions here, but I don't really see anything that's directed at me. How small an account? You're really talking. I'm going to say you could probably get away with $5,000 or so, maybe even $4,000. The problem is you can put your pressure on yourself that if you are losing 3 or 4 times in a row, and you can get very easily, especially early on, you can get yourself to the point where you lose 5 or 6 in a row over a couple of days. Well, if you lost 500 over that, that's $3,000. Now, your account will have gone down by such a significant amount that you may need to put more money in there to be able to continue to trade. We'll cover that in just a second, Maria. Make sure that I go over there in just a second. The charting, well, in fact, why don't I go back up? Let's do that right now. All right. If you go out there and search on Google for a thing called R-Squeeze. Now, R-Squeeze, this is Ninja Trader that I trade on. I got it from free membership. I actually have a paid membership from a thing called futures.io. And they charge about $100 to get out there. They have a whole bunch of people that share, some of them free, but some of them paid, meaning you have to be a paid member to get in. And they'll have these indicators. Now, basically, it's a combination of Bollinger Band being inside the Keltner channels. Now, we're going to look inside an ebook that I'm going to give you at the end. It'll go into give you more detail about what the R-Squeeze is and where you can find out more information. There are links to them. And if you look at TTM squeeze or R-Squeeze, Google it and look under John Carter, you'll find out what you are. And then, let's see, the second question is, talk about the Renko settings. Okay. Now, you're going to see here, let me get up here to get a drawing tool. I'm going to put it back to green. I don't like to use red. Red is bad. All right, up in here, so that the traders in my room can see right in their face what instrument I'm trading and what are the settings I'm using. I use 6 ticks with a 10-tick reversal and a 2-tick offset. And that's what I have normally used in a slower, more methodical market. However, in the last week or so, we've had to bounce back and forth to a 10-tick 14 or a 12-tick. What is the number? I want to say this is 16 or 18. I'd have to use it because I don't use it that often. And here's the problem. If you have a 6-tick, usually the stop is inside the $150 to $250 range. If you use 10-tick, your number of ticks to the stop are somewhere in the neighborhood on 2 contracts of $200 to $400. So you can blow yourself out in one trade that goes totally against you. And 12 ticks, most of the time you're going to get stuff that's going to be outside of my dollar amount that I want to risk on a trade. But I have to do my analysis, and which settings I use are not based necessarily upon what I want to do. I would love, if everything is good to go, I like to use the 6-tick 10-tick reversal. So I call it 610 because that gets my stops tighter, helps me control the risk in dollar amounts. But if the market's too volatile and the swing levels are too far away, I have to go to the higher one. It might mean reducing down to 1 contract. Or I have to raise the amount that I'm willing to risk on one trade. You guys have got to make that call yourself. And yes, Herbert, I just basically take what's the calculation that is inside NinjaTrader, which is, they call them pivots, but they're trader pivots, and they are the standard calculation. I don't really care, personally, about, even how they're created or where they show up on the chart. The ones that are straight out of NinjaTrader, pull out of the charts, they're good enough, because I'm not using them to determine buy or sell points, exits, targets, anything. I'm just trying to be aware that if I get to that level, I might get a wobble. Remember, I'm trying to get into the weakest of the weak markets to the downside, the strongest of the strong. It may only get to that level and then pause temporarily. Maybe only 2 or 3 candles and then keep on going. Sometimes not even that. But I just want to be aware that those trader pivots there. So it's in the background, but I don't use it as a primary trading. Yes, I have an autopilot for the swing levels. These are basically created, and it's a strength of 3. Now, you would have to necessarily change them depending upon the time frame or the settings that you use, but I found 3 works best on the 6, the 10, and the 12. If I go to faster than that, I may have to change the strength setting. If I go to a one that's more than that, I might have to change the setting. But for what I'm using, that's usually good enough for me. And these swing levels are support levels and resistance levels, up or down. And the markets tend to bounce between swing levels. Once they break through some level here, they tend to go. Now, why did this one not stop at this level here? Now let me go back a little bit. Why did it not stop at this level? Well, guess what? Look at this candle right there. Wait, hold on a second. Let me highlight it. It actually did, but it did an intra candle. See the upper wick on that one? It came down, it went back up, and then it went down lower. So somewhere either at the level that we're talking about here, or the level here, and I'm not sure whether it went down, up, and then closed down, or went up and then down. It doesn't matter. It probably wobbled around this one for sure, and maybe even that one, but I'd be able to see it live, how it develops. Again, remember, the weakest of the weak markets, we see them right here, that is pretty darn weak. It'll blow right through those levels. So I just have to be aware that that level might be broken. Did that answer your question again? Talk about stops. Usually 2 ticks for me. And what is it to set? Well, it's the strength of 3, and I'm not sure exactly how it's calculated, to be honest with you. Personally, I played around with it. The strength settings could be 1 to 5. 1, 2, 3, 4, or 5. Default out of the box for NinjaTrader is 5. I found that to be too demanding for the times, for the short time frames that I'm looking at. So 3 seems to work very well for me. 2 is a little bit, you get too darn many of them. And you'll basically have to play with it based upon what the Renko bar settings you're using. Bricks. Okay, thanks for the questions. Appreciate it. Let's go down here to some chart examples. I'm going to show you single contract trades and dual contract trades, 2 contracts. Right now, I've not earned the right to go to beyond 2 contracts. Yeah, I probably have. But I want, my goal in the room is not to make the maximum amount of money that I can, because people would not be able to trade like me. I want to trade as if I'm the average retail trader who doesn't have a lot of money. And I can show you how to get that. And then once you get one, you get successful enough that you can earn the right to trade in greater sizes, or two, have the physical wherewithal to be able to withstand larger moves. You can trade larger numbers of contracts. Then so be it. All you have to do is do multiples, and we talk about that in the room. However, I want to be as the lowest common denominator. No, I don't ever use for Nadex at all. I've got a couple of friends that have used it occasionally, but I find that I make enough right here. I don't have to be if you try to be a jack of all trades, you'll be a master of none. I think that that's pretty valid here. All right, single contract. I want an entry on the break of a swing, and we looked at it, and let's go right here. And you see how we had kind of a consolidation, a little messy one here. And in my counterpunch trader, I have an $1,800 system that I purchased, but I don't always use it, but it's nice to have in the background occasionally. I went long just above the break of the box, right in here. Actually, right over here. And look down into here. If you look and see right there, this is what was called a chop. It says that it broke out of the chop as we went through here. Well, I don't need a oscillator to tell me that it broke out of chop. I can see it. Well, this just helps me. It's kind of a confirmation, a secondary indicator. Well, I go long there, and I let it run up to, there's the nominated targets. Okay, the system nominated 3 targets. The first orange dot here is what they call money management. It has to have it stop down here at the last swing level until it gets to this level, which is about 10 ticks of profit. Then it will start moving the trailing stop up. I also have this, the green, dark green dots here. That is the trailing stop created by the counterpunch trader, CPT. The lime colored dots that you're seeing here, those are a chandelier stop, which is nothing more than a volatility stop, which is nothing more than plotting versus average to range. And so it starts to move up first. When I go long, I use the average to range until the computed counterpunch trader starts to catch up. And you do notice that this average to range pretty much sits right along with the 9 volume weighted moving average, the fast, or I call the signal line. Okay, I don't use it to tell me anything more than this is a trend. This is the beginning of a trend, because the fast is over the slow. There's a difference between each other, and they're not squeezing together. They're actually getting further apart. That helps me visualize the trend. And when I trade one single contract, I get out at target 2 the vast majority of the time. Because I found that if I get out at target 2, that will keep me profitable. I would love to get to 2 contracts. And on this one, this is a perfect example of why you want to be in 2 contracts, because the first one, I could have taken it off right here and taken it off at about 15 to 20 ticks. And on the second one, I could have either gotten out at target 3, or I could have trailed it up to a stop out up here. It went up an additional 40 ticks after I got out. Still risking this, but why did I not do that? The risk was too high. The difference between the entry up here all the way down to the stop down here was too much. It exceeded the dollar value that I had set in my maximum risk. All right. Before I go on to the next trade, I'm going to come over here. Kevin asks, how do I get color shading between the two moving averages? It's FM. It's magic. No, actually, there is a program out there that I will share to any member out there that color codes that, and we created that. So there are a few things that it can be coded, but I don't want to give away everything. But this is one of those that I had a guy who's now a member of our room. I had him coded up, so I had to pay him for it. So I like to give it away to paid members. But it's basically when the signal line is above, the fast is above the slow, it's green. When the slow is above the fast. Sorry, the fast is below the slow. No, I think below the slow, you'll be red. Now, I want one other thing for you. Yes, Art, it only works on NinjaTrader here. Now, one thing I would like for you guys to do. There are probably programs out there that will allow you to do something similar to this. All the time zones are Eastern Standard Time or Eastern Time. Google that you want some sort of colored moving averages or anything like that for either NinjaTrader or TradeStation or whatever you're trading. There may be something out there. One of the reasons I'm in NinjaTrader as my trading platform is because there's a lot of free stuff available. Things like this wasn't available for free that I could find. So I worked with the member and paid him to go ahead and do that for us. And then I share it with our members. Okay. Sorry about that. I'd love to give everything away, but I can't give away stuff that's that I have to pay for free, to be honest with you. Again, second one was a single contract. I entered on a bounce. Let's go ahead and mark this puppy up. What did it do? It broke the level. It formed the old zigzag, where it went down below this swing level, went back up here and formed another swing level, and then rotated down. I'm sure that what it did is it got a lot of people short and then went up here and ripped their lips off and had them cover and went right back down and made them feel stupid. After being made to feel stupid myself so many times, I attempt to judge momentum and where we are in the pattern. We got down to the low here. I drew a line. We got back up here. I can go short at the red line. I can use a stop up here at the blue line where the swing level is, or because that was a wick, not a body, I tend to use the body. So I will be able to lower that just a little bit and stay within my risk. I made 48 ticks by just continuing to follow this down. I did not have a counterpunch trader signal come in on this. I did this on my own based on what I could see. And I did a trailing stop. I got out down in here before it came out and actually hit the trailing stop. What I did is I looked over to the left and I saw some congestion. I thought that it might act as resistance. And notice what happened here at R1. We got a big wobble. All of these wicks to the upside. And then eventually, once it really got on the other side, it picked up steam to the downside. You have to make a judgment up to whether you think it's going to go lower or not. Well, I didn't see any support levels to the left. So all I saw was this trader pivot. And I said, I don't think it's going to stop. It's a judgment call on my part. Could you have been wrong by taking profits at R1? No. Would you have been wrong from the maximizing profit level? Sure. You have to decide. You have to trade. You have to simulate it and go through the trades yourself over and over and over again to find out what works. I was finished today at about 10:30 trading, but I stuck around till about 11:15 to 11:30, and I walked through every one of I watched those 3 indexes move around, and I said, if I were going to trade, I would be going short here or going long here. And this is where I think it's going to. Basically, exercising that brain and my eyeballs to be able to see entries, targets, and stops. The more you do it, the easier it becomes. And you've got to be able to see everything and go in after the market if you didn't get to do it during the regular hours. Next one was also a single contract. I entered on a zigzag plus the sell signal by Counterpunch Trader. What does that do for me? Well, basically it gives me confidence that what I saw there myself, the computer saw because it was spitting it out as well. And target 1, target 2, target 3. I'm looking over to the left. I'm looking down here at the momentum indicators, and you notice I have 2 of them. One of them is the chop filter that is proprietary that I'm unable to share, except I can show you what I'm using. I own the rights to that. I don't own the rights to share it, but this one I think is a freebie that's out there, and I could share that with anybody in the room. And with this, I judged it and I said, you know what? I'm not taking it off at target 2. I'm going to see if I can get to target 3. I'm going to see if I can get all the way down to S1. All right. I ended up covering, I think it was 1682 was somewhere around 1688 too. It was somewhere in between target 2 and target 3. It ran to S1, the trailing stop, many times. The trailing stop will equal target 3. The target 3 projection in this system will be about the best you get, except I'll show you an exception today. Here's a 22 tick to the upside. All right, what do we see here? I'll try to pick up the pace just a little bit here. We had kind of a congestion zone going here with a little dip below. Basically, you've got a consolidation area within a consolidation area. We have a breakout. Where is it possibly going to hit resistance? Probably at this level right here, and it did do a wobble. And it went up here and hit a resistance level, a swing level that was over to the left that I'm calling resistance. And I took the money. Take the money and run. Especially when you have a single contract, you don't have the luxury necessarily to give it lots of room. I exited, and it's really covered up by this label here. Target 3 was right about where the K was. And that's what I did, is I got in a little later than their signal, which was down here. No way I was getting in down there. It was still too iffy for me. I got in at the right point and right level, but I was seeing if it would run to target 3. And that's what I chose to do, which just happened to match up with prior levels. You can do this in overnight trading. And in fact, if enough people want to try to do it, we will probably have a few days where we come into overnight trading. I found anywhere between about 8:30 or 9 or 9:30. In those 3 time frames, we'll get a movement. And they're really good to trade. Now, this was in the Dow. And what happens is we use the exact same criteria. We use break areas here. And what it did do right here, it did a wobble just underneath. So it did a 1, 2, 3 zigzag. 1, 2, 3. To be honest with you, I wasn't around at that point because I came around thinking it was going to show up at 8:30. I showed about 8:15. I said, "Oh, I've already missed the trade." Well, keep an eye on it there, Stevie. All right. We got down to the primary pivot level, and we had a little bit of a motion, and it actually got up as high as this level right here where you can see the top of the wick, and then it failed. The counterpunch trader system gave us an additional sell signal. It gave one up here and one down here. I went down long this one, and I tried to trail it out as much as I could stand, and I got 34 ticks down to target 3. Did it go lower than target 3? Yes. Am I okay with getting out early? Yes. 30 some odd ticks is very, very good. You're talking at $5 a tick, you're talking about $160. If you had 2 contracts, you could probably make it 45 ticks. Okay, getting out on target 1 and target 3. All right. The whole idea is to hit singles and doubles. Not necessarily, you don't need home runs to make money. I'll get pretty quick here. Again, target signal, go long, have to take a little heat, goes up to target 2, exit. Where did it get to? Somewhere between target 2 and 3. Where did the trailing stops get out? Somewhere around target 1. So I got reasonably lucky / I read the tea leaves. I saw where this curve on the momentum oscillator was starting to roll over. If I had the R squeeze on, I would have already seen that one rolling over as it got to here. And that would give me the indication. And that's why I went to adding the R squeeze in there, because has a quicker twitch. It is a different time frame, and it will be faster to show when we're running out of momentum. All right, go faster, Steve. Again, another overnight trade. That one's at 9 o'clock. Break out of a consolidation area. You can see it right there. Where's your stop need to be? Well, technically you need to be all the way down here. You could probably be down where the volatility stop is. And when I went long here at 303, so that's 24,303, I'm going to use the volatility stop as my stop. That's halfway closer to where I'm at. So that's okay. And then run it up. And I'm not sure. I think it does. I got to 40 ticks and I said I can't stand it anymore. I don't know if there was any swing level over here to the left or not. But it was far extended, and I got to a dollar level that I was happy with based upon the risk reward. That is an excellent return on a risk. It's 2.66 times risk. That was good. 15 tick risk to over 2.5 times that. All right. Now we're going to go into the trading room. I'm going to do a little bit of a sales pitch. I do know that you guys don't necessarily want to hear it, but I think you should listen here. Why? I started with an $8,000 account. I risked no more than $150 to $300 a trade. I usually only trade in the mornings. Occasionally you see me trading at night. Occasionally I'll be in the afternoon when we have the FOMC minutes or anything that happens that's special. But my ROI is over 100% today. I wanted to prove, and I'm still trying to prove to everyone out there, that you can do well with a small account. And the consistency helps you to grow to a larger account, to learn how to do it, and to allow you to graduate to more contracts. I will probably stay at the lower level just because I want all people who are new to see that you can get a nice, steady increase in your profits every month. Now, if you want to increase the dollar profits, increase the number of contracts. There's a couple of ways to do it. I can show people how to do it. You could either double it and take 4 contracts. If you don't feel comfortable with that, take 3. You could take 1 at target 1, 1 at target 2, 1 at target 3. Or you could take 2 at target 1 and try to do the runner on the next one. There's a number of different ways you can do it. You need to back test it. So, the key here is I'm going to have losses, and I'm going to show you in the next slide. Even though I've had 100% ROI in the 17, 18 weeks since the 1st of May when we started the room. There are going to be drawdowns. Now, I don't have any drawdowns on a monthly basis, but I have drawdowns on a daily and weekly basis. And I want you to avoid anyone says that they have very 90% wins. Well, either they're taking very quick losses or they're lying. And if they have no losses, they said, that's total garbage. Put your hand on your wallet and run the other way, because everybody has losses. And a really good win rate is 60%. And if you get more, you let your winners run more than you do your losers, you only need to make a little bit over 50% winning. It really infuriates me, some of these people that go out there and make these claims that are absolutely bogus. All right, these are the trading room results. I upload them every day. People watch over my shoulder and they see how much I've made or lost in a day. I tell them how much I've made or lost in a day. August has been a difficult month. It's summer trading month. We've had a lot of intraday news with tweets and whatever on tariffs. The reward to risk levels have been, the risks have been higher than my rules allowed sometimes, that made me miss some entries. We've had some erratic follow through. So things just didn't follow through that should. Now, I'm trying to do primarily a breakout trade. It's not a daily breakout, it's a intraday breakout, and they do tend to work. Well, if they sit there in a trading range and bounce around for 45 minutes to an hour, my patience level starts to get, the bungee cord gets too tight, okay? Well, I lost some patience and I went long in the middle of a big trading range without the indicators telling me that I probably have a green light that it's going to break up or break down. And you can see how I've had some pretty doozy loser days. I got a 590 and a 560 last week. I've had 3 losing weeks. Of course, only the largest was 130, and we're already up over $900 this week, and we're up almost 104% since we started on 1 May. All right. Last of the sales pitch. Brand new room. I argued with the owner and I said, I want to make this affordable to the average Joe Blow and mild Marys out there. $273 is what we're going to charge for a whole year. That's less than $23 a month. Most people will charge minimum of $100, if not $300 a month. Hit and run candlesticks, Top Gun futures. That's where you get first 35. We still have some open seats. We actually have I didn't show it. We have an open house between now and the 31st of August, which is next Friday. You can come in for free and look over the shoulder. I'll have to get the... is there a way, Ron? Is there a way for you to copy this link and post it out there for him? I'm not familiar with GoToWebinar and how to share that out there, please. And there's some additional resources. There is Hit and Run Candlesticks, where if you wanted to sign up or find out more about me, you can find it there. I have a YouTube channel. I have a stock Twitch handle. And I have an email if you want to email me with a question or anything like that. but I post the entire session onto YouTube, good and bad, every day. You can look at my 1 to 2 hours worth of trading and look and see, and I'll do a live commentary, give you an idea of what it is. And then if there's a good, either a good winner or loser, I will post those out there because it's a learning lesson. All right. Now, I want to thank everybody for listening. We'll open up for questions. Ron, we have the slides out there available for everyone. It's in the handouts. And there's a free ebook for everybody who's stuck around this long. It talks about the charts and patterns. It's really mostly just the basics of what we've already covered here, but it adds on a little bit more information. Well, is that right? Do I have no losses on Friday? You know what? I do have 3. Right. Friday I've always said was my worst day. When I look back at it, my worst day was actually Monday and Wednesday. Those were the worst days when I added them up on the average. And Thursday. The best day, Friday. You're right. Friday had no losers. And I would be surprised. But I've learned when I did a trading journal, that Fridays were ugly for me. So I become extra vigilant on Friday. I will only take the best of the best. And you see one day where we didn't trade up here, I believe that was on options expiration day. Now we had an options expiration day here just recently and we made 250 on it. But we weren't trading in the afternoon at all. I don't know. There was no way I'm going to trade on Friday afternoon. No way. I'm going to go out and play golf. All right. Did we share the PDF of the presentation and the ebook there, Ron?
Yeah. You have to tell them that they need to go to the control panel.
Yeah.
It's on the bottom of the control panel. It says handouts. Double click that, and there are 2 handouts that you can download.